Welcome to Cruise News, your daily update on everything happening at sea. Visit cruisenews.io to see today's stories and sign up for email alerts.
Glad to be here.
So, if you are a cruiser listening to this right now and you're thinking you can just wait until late 2025 to, casually book your 2026 summer vacation, you might be in for a massive wake-up call.
Yeah, a really big one.
Right, because today we are doing a complete 2026 reality check. We're looking at the unforgiving physical realities of weather-driven port changes. We're looking at the brutal financial pressures of corporate execution.
Which are intense right now.
Exactly. And we'll get into why certain cruise lines are already selling out of next year's inventory. And I think if there is one single word that ties all of this together, it's control.
Control. Yeah, that is the perfect lens for this.
Right, like which lines have it, which lines have completely lost it, and how that directly impacts the vacation you are trying to take.
Because, 2026 is no longer some distant concept on a whiteboard somewhere.
Oh.
It is a present-day reality. It's dictating billion-dollar decisions right now.
Yeah.
The companies that are actively seizing control of their physical and commercial operations, they're thriving.
Mm-hmm.
And the ones reacting after the fact, well, they are getting heavily penalized by the market.
So let's start with the ultimate test of control, which is the physical environment. Before we even get to the boardroom battles and the financial reports, we really have to talk about the sheer physical execution of operating a modern megaship.
Oh, for sure.
Because, look, the weather, frankly, does not care about a perfectly marketed itinerary.
No, it really doesn't. And the proactive shift we're seeing in the industry's execution baseline is just fascinating. Cruise lines are simply no longer willing to roll the dice on weather.
Right. Let's look at a very specific present-day example of this. So Costa Cruises recently announced they are completely dropping La Goulette, which, for the listener, is the port for Tunis in Tunisia.
Right.
They're dropping it from the Costa Smeralda's March 4, 2026 itinerary, and they are swapping it out for a full day in Naples, Italy.
Massive change. Huge. And the stated reason isn't geopolitical. It isn't demand-driven. It is entirely about the wind. They are forecasting strong winds and gusts exceeding 40 miles per hour, which actually crosses the port-established wind limits for a safe access channel transit.
And Costa is not an isolated case here at all.
Right.
MSC Cruises is facing the exact same structural geographical issue at that very same port.
Really? At La Goulette?
Yes. The MSC Splendida actually canceled its La Goulette calls for January and February of 2026. Same reason. Predicted winds up to 50 knots, which, if you do the math, translates to about 57 miles per hour.
Wow. 57 miles per hour. That is serious wind.
It's incredible. So for their February 12th sailing, instead of risking it, they just opted to turn it into a sea day. They expanded the onboard programming, fired the Formula One simulators, ran the 4D cinema.
They kept everybody entertained on board.
Exactly. And then they substituted a call in Palma de Mallorca, Spain for the following day.
I always try to visualize the physics of this for you guys listening.
Yeah.
Because 34 miles per hour is generally considered the absolute upper limit for safely docking a cruise ship.
That's the baseline.
Now, think about the Costa Smeralda. That ship is 185,000 gross tons. It carries over 5,000 passengers. It sits incredibly high out of the water.
So high.
Trying to maneuver a vessel of that sheer volume through a narrow channel in 40 to 50 mile per hour winds, it's like trying to parallel park a skyscraper in a hurricane, right?
Yeah, the physics of it make it nearly impossible.
Yeah.
The surface area of the side of these modern megaships acts exactly like a giant sail.
A giant sail.
Right. In the maritime industry, they actually refer to this as windage. When you have a massive block of balconies and superstructures catching a 50-mile-per-hour gust, the lateral force pushing that ship sideways is just immense.
I can't even imagine the pressure on the thrusters.
It's too much. If you are trying to transit a narrow port access channel, like the one in La Goulette, which is in a very exposed coastal setting during the winter and early spring, the thrusters on the ship simply cannot overpower the wind pushing it toward the rocks. It becomes a severe safety hazard.
But what really stands out to me here is the sheer geographical and the logistical scale of these changes. Swapping a North African port like Tunis for Naples, Italy, or Palma de Mallorca in Spain,
Right.
that is not taking a minor detour down a side street. You are completely redrawing the map for thousands of people.
Yeah.
Walk me through the mechanics of that. How difficult is it to just, swap a port?
Oh, it is a massive logistical undertaking. You don't just point the steering wheel toward Naples and say, hey, we're here.
Right.
When a line changes a port call, they have to secure an open berth at the new port, which is highly competitive right now. They have to arrange for local harbor pilots, tugboats, and longshoremen to handle the mooring lines.
You have to coordinate all those ground teams.
Exactly. Then there is the provisioning. If they were planning to load fresh produce or offload waste in Tunis, they now have to coordinate all those vendor contracts in Spain or Italy. Wow. Furthermore, the ship's entire fuel consumption route has to be recalculated based on the new speed and distance required to hit those revised arrival times. Doing this a year in advance takes an incredible amount of operational coordination.
Which brings us back to that central theme of control. Both Costa and MSC are making these decisive itinerary changes weeks, or in this case, actually months in advance.
Very early.
Yeah. Costa is automatically processing refunds for canceled shore excursions right back to the original form of payment or the onboard accounts. They are not waiting until the morning of the arrival to see if the wind magically dies down.
Which is the critical difference. Historically, a captain might sail toward the port, wait offshore, and just hope for a break in the weather.
Cross their fingers.
Pretty much. And if it didn't happen, the call was scrubbed at the last minute. The passenger wakes up, looks out the balcony, and is told, sorry, too windy, we're spending the day at sea.
Which ruins the day for the passenger.
It totally does.
Yeah.
By making the call early, the cruise line takes control of the narrative. Yes, they take a short-term hit by automatically refunding those excursions early, but they preserve the brand relationship.
That makes perfect sense.
They prioritize safety, but they also provide the passenger with a guaranteed, predictable alternative. It's a prime example of rigorous operational execution.
Okay, so making early calls on weather is an example of strong operational control. But what happens when a company loses control on a commercial level?
That's where things get ugly.
Yeah, because I want to pivot to the corporate execution pressures currently facing Norwegian Cruise Line Holdings. They are having a remarkably tough moment in the market right now.
The market response to their recent updates has been incredibly severe.
Yeah, their shares recently sank 11% in early trading. And while Carnival and Royal Caribbean took minor sympathetic hits, Norwegian's drop was heavily tied to their specific 2026 projections.
Very specific.
They projected a 2026 adjusted earnings per share of $2.38. Now, Wall Street analysts were expecting $2.55. On top of that, they announced they expect flat net yields in 2026. With the first quarter of 2026 actually seeing a net yield drop of 1.6%.
Let's break down why those specific numbers caused such a dramatic sell-off. Earnings per share, or EPS, is essentially the company's total profit divided by the number of outstanding shares.
It's the bottom line for investors.
Right. It is the ultimate scorecard for Wall Street. When a company misses that expectation by 17 cents, it signals to investors that management's internal forecasting is flawed. And the phrase from their update that really alarmed the market was the admission of self-inflicted execution gaps.
Yes. Their new CEO, John W. Chidsey, literally used that phrase, self-inflicted. They had this massive 40% year-over-year capacity increase in the Caribbean. But it was poorly aligned with their marketing, and crucially, it was completely out of sync with the operational readiness of their private island destination, Great Stirrup Cay.
A huge mistake.
They didn't have the full slate of amenities ready for the passengers they were bringing in. Wait, help me understand this disconnect. Consumers are spending record amounts on vacations right now. How does a massive, sophisticated corporation like Norwegian drop the ball this hard on their own private island?
That's a great question.
I mean, to me, it sounds like throwing a highly advertised grand opening for a brand new luxury restaurant, inviting the entire town, and then realizing on opening night you forgot to install the ovens in the kitchen.
The restaurant analogy is spot on. And if we extend it, here is what actually happens behind the scenes. In a corporation that size, forgetting the ovens means your marketing and commercial team sold thousands of premium tickets based on the promise of a fully upgraded island experience.
Right. They sold the dream.
They sold the dream. But the operations team, the people actually pouring the concrete and building the cabanas, were on a completely different timeline.
They were working in silos.
Exactly. When those two silos don't communicate, you have a disaster on your hands. The commercial team fills the ships. A 40% capacity increase in the Caribbean is a massive influx of people.
Oh, yeah. Thousands of extra people a week.
But when those passengers arrive at Great Stirrup Cay and the amenities aren't finished, the cruise line can't charge premium prices. They have to issue massive refunds, offer discounts, or give away onboard credit just to apologize for the construction. That directly destroys your pricing power.
Which explains that flat net yield metric we mentioned earlier. For the listener, what exactly is net yield, and why is it so dangerous for it to be flat?
Net yield is essentially the true profit a cruise line makes per passenger, per day, after you strip out all the unavoidable costs of getting them on board. So if you pay $1,500 for a cruise, the line immediately has to subtract travel agent commissions, port taxes, and the cost of the flights if they were included in the package.
Okay, so whatever is left is the net yield.
Exactly. What is left over is the net yield. If your net yield is flat or dropping 1.6% like Norwegian's first quarter projection, it means you are losing your ability to squeeze profit out of each ticket.
And that is incredibly dangerous because their costs are not flat.
No, they're climbing.
Their chief financial officer, Mark Kempa, noted that their fuel costs are projected to rise from $662 per metric ton in 2025 up to $670 per ton in 2026. So if your costs are going up, but the profit you make per passenger is flat because you have to discount for a half-finished private island, your margins just collapse.
Precisely. And the pressure isn't just in the Caribbean. Campa also pointed out pricing softness in Alaska.
Yeah, I saw that.
He specifically tied that to mid-single-digit industry capacity growth. When every major cruise line decides to send an extra ship or two to Alaska to chase the money, the market gets flooded with cabins and prices soften across the board.
Supply and demand.
Exactly. Furthermore, Norwegian didn't see the expected momentum in Europe, and they are facing pricing pressures while trying to roll out their new Philadelphia home port.
So you have a perfect storm of lost operational control, siloed departments, unfinished projects, rising fuel costs, and increased competition in key markets.
Well, rough.
When you have execution lapses like this, the wolves start circling the boardroom, don't they?
They do. And in this case, the wolf is Elliott Investment Management.
Oh, boy.
Yeah. They are an aggressive activist investor firm, and they recently disclosed an ownership stake of more than 10% in Norwegian Cruise Line Holdings.
That's a huge stake.
It is. When an activist investor buys up that much stock, they aren't just looking to hold it quietly. They want to force changes to maximize their return. And they are aggressively escalating their demands ahead of the annual shareholder meeting.
Yeah, I saw their statement. They publicly called out a troubling pattern of execution lapses and strategic missteps. They are demanding a comprehensive board refresh. They want stricter cost controls, and they are pushing heavily for a former Royal Caribbean executive, Adam Goldstein, to join the board.
Which is a very specific demand.
Right. And Elliott claims that if Norwegian can just fix these execution gaps, the stock could lift to as high as $56 a share. That would be a 159% increase over recent levels.
The data underneath the surface points to something really critical here, though. The problem Norwegian is facing isn't a lack of consumer demand. The consumer is still extremely healthy, and Norwegian's own portfolio proves this.
Right, because they own more than just the main contemporary Norwegian brand.
Correct. Their luxury brands, Regent Seven Seas Cruises and Oceania Cruises, are seeing incredible numbers.
Oh, really?
Yeah. Regent just recorded its strongest booking month in history this past January. Oceania is seeing record booking activity for their newest ship, the Oceania Sonata. And that ship doesn't even debut until August of 2027.
Wow. So passengers are perfectly happy opening their wallets for the ultra-premium experience.
They are. The luxury brands tend to benefit from longer booking curves, meaning passengers book further in advance. But more importantly, those brands are executing well.
Right.
The operational and commercial pressure is almost entirely concentrated on the contemporary Norwegian Cruise Line brand, which is the largest piece of the company's portfolio.
So it drags everything else down.
Exactly. That's why the issues there are dragging down the consolidated numbers so heavily. It is a pure internal execution issue on the contemporary side. Activist investors like Elliott look at that and see massive unlocked value. They believe the underlying asset is strong, but the management's grip on the steering wheel is just loose.
That distinction between the contemporary struggle and the luxury success perfectly bridges us to our final segment. Because while Norwegian's contemporary brand is struggling to align their capacity with demand and getting hammered by Wall Street analysts, Viking Holdings is facing the exact opposite reality.
Night and day.
They are quite literally running out of inventory for 2026.
The contrast in operational control is staggering.
Let's look at the numbers because they are jaw-dropping. As of February 15th, 2026, Viking has already sold an astounding 86% of its 2026 capacity for its core products.
That is just unheard of.
Just process that for a second. 86% of their cabins for the entire year are already gone. by February.
Unbelievable.
They are sitting on $5.96 billion in advance bookings. That is 13% higher than this exact time last year. And keep in mind, their operating capacity for 2026 is actually 7% higher. They have more ships and more cabins to sell, yet they are selling out faster than ever.
And that level of advance booking translates directly to the strength of their balance sheet. Their 2025 financial results were entirely record-breaking.
Tell me about it.
They posted $6.5 billion in total revenue. They achieved a 95% occupancy rate in the fourth quarter. And crucially, their net leverage dropped all the way down to 1.1x from 2.4x the year prior.
Okay, for those of you listening who are not living in financial spreadsheets, explain net leverage. Why is that drop from 2.4 to 1.1 such a big deal?
So net leverage is a ratio that measures a company's total debt against its actual cash earnings. The cruise industry is incredibly capital intensive, right? Building ships requires taking on billions in debt.
Billions.
When a company's net leverage drops to 1.1x, it means their earnings are so strong that they could almost pay off all their corporate debt with just a little over a year's worth of profit. It is an indicator of massive financial health and stability.
And they are certainly using that stability to expand. They are taking delivery of 2 new ocean ships and 10 new river ships in 2026 alone. Plus, they have options for more ocean ships in 2034 and expedition ships coming in 2030 and 2031.
They're not slowing down.
Not at all. But I want to play devil's advocate here for a second. Is this massive advance booking rate purely just the luxury of serving the premium older demographic? Because we just established that Regent and Oceania are also doing well in that luxury space. Or is Viking actually doing something fundamentally different with their physical ship design and operations to secure these insane margins?
It is absolutely the latter. Viking's success is a masterclass in operational control, and it is entirely tied to how they design and build their physical hardware. Their CEO, Torstein Hagen, points specifically to their strategy of building interchangeable, purpose-built ships.
Meaning all the ocean ships are virtually identical clones of each other?
Yes.
And the river ships have a strictly standardized design as well, right?
Exactly. When your ships are completely interchangeable, you unlock massive economies of scale. First, building them is cheaper because the shipyard doesn't have to re-engineer the blueprints every single time.
Oh, that makes sense.
But the real magic happens in the daily operations. When every ship has the exact same layout, the same engines, and the same galleys, your crews become incredibly efficient. A chef or an engineer can transfer from one Viking ship to another and instantly know where everything is.
They don't have to relearn the ship.
Right. You only have to warehouse one type of spare part for the entire fleet. This lean, standardized operation drastically reduces wasted space and weight, allowing for a remarkably fast payback period. They pay off their ocean ships in 5 to 6 years and their river vessels in just 4 to 5 years.
Which gives them an incredible buffer against the chaos we saw with Norwegian.
It gives them total armor. Because their core demographic locks in their travel so early and their operations are so standardized, Viking has built a massive financial cushion against the very variables currently plaguing the rest of the industry.
Like the fuel costs.
Take fuel volatility, exactly.
Yeah.
We just discussed how a few dollars per ton in fuel costs is hurting Norwegian. Viking controls this in 2 ways. On the ocean side, their ships use closed-loop scrubbers.
Which are essentially giant exhaust filters, right?
Yeah, exactly. A closed-loop scrubber washes the sulfur out of the engine exhaust. This means Viking can purchase cheaper, unrefined, heavy fuel oil, clean the emissions themselves on board, and still strictly meet all environmental regulations.
Wow, so they save on the raw fuel cost.
It is a massive structural cost advantage.
Yeah.
And on the river side, they secure fixed-price fuel contracts for a significant portion of the season. They are actively hedging their bets to lock in their expenses.
Wow. So they are locking in their revenue billions of dollars in advance, and they are locking in their operational costs at the exact same time.
Yep.
That is the ultimate definition of control. It seems like even global geopolitics doesn't shake their model. I know they did have to temporarily pause their operations in Egypt due to the ongoing tensions in the Middle East, but they noted that Egypt only accounts for about 3% of their total capacity.
It's a tiny fraction.
Yeah. Analysts from Jefferies and BNP Paribas both pointed out that this localized pause hasn't slowed Viking's overall booking momentum at all, and their pricing trends are actually accelerating.
Which really brings us full circle to the reality of 2026. You have contemporary lines that are locked in fierce capacity battles, fighting over pricing in the Caribbean and Alaska, dealing with siloed marketing teams and activist investors.
It's a mess.
Meanwhile, Viking is sitting above the fray, utilizing identical ship designs and fuel hedges, and they are essentially finished selling 2026. They are operating on a completely different timeline than the rest of the industry.
Which leaves you with a really provocative thought about where this entire industry is heading and how you have to plan your own life. If 86% of Viking's 2026 core capacity is already gone by February, and the contemporary lines are brutally fighting for whatever market share and pricing power is left over, what does this actually mean for 2027?
It's a great question.
Are we entering an era where passengers must plan their vacations 2 to 3 entire years in advance just to secure the itinerary, the cabin, and the price they actually want? Because looking at these numbers, it seems the days of casually booking a premium cruise just a few months out might be a luxury of the past.
It certainly looks that way.
Thanks for listening to Cruise News. Visit cruisenews.io to catch up on the latest updates and sign up for free email alerts.